Hey there, tech enthusiasts! Today we're diving into a pressing issue. Why are automakers' investments in EV factories not paying off in the US? Despite massive investments and government support, the electric vehicle transition is hitting some serious roadblocks. Join us as we explore the challenges and complexities behind this unexpected turn of events. Several factors contribute to the challenges faced by the industry, impacting both the financial viability of these initiatives and the broader EV market in the US. Number 10. High initial capital expenditure. One of the most significant barriers to the profitability of EV factory investments is the high initial capital expenditure required for setting up production facilities. Building new plants or retrofitting existing ones to accommodate EV manufacturing involves substantial costs, including advanced machinery, robotics, and specialized training for workers. Automakers are also investing in research and development to create competitive EV models, further straining their budgets. The high upfront costs can create financial pressure on automakers, particularly if the anticipated demand for EVs does not materialize as quickly as expected. Additionally, automakers face competition from new entrants in the EV market, including startups and tech companies, which may have lower overhead costs and more flexible operational models. Number 9. Supply chain disruptions. The automotive supply chain has been significantly disrupted in recent years due to the COVID-19 pandemic, geopolitical tensions, and ongoing semiconductor shortages. These disruptions have delayed the production and delivery of critical components needed for EV manufacturing, such as batteries and electronic control units. As automakers ramp up their EV production, they are increasingly reliant on complex global supply chains that can be vulnerable to disruptions. These supply chain challenges not only impact the production timelines, but also drive up costs, as automakers may need to source materials from alternative suppliers at a premium price. The inability to secure essential components can lead to lower than expected production volumes, and consequently fewer EV sales. Number 8. Consumer adoption and market penetration. While consumer interest in EVs has been growing, the overall market penetration of electric vehicles remains relatively low in the US compared to traditional internal combustion engine (ICE) vehicles. Factors such as range anxiety, charging infrastructure availability, and higher upfront costs for EVs compared to their ICE counterparts continue to deter some consumers from making the switch. The slow pace of consumer adoption can pose challenges for automakers who have invested heavily in EV factories with the expectation of a rapid transition to electric mobility. If demand does not meet projections, automakers may find themselves with excess production capacity, leading to financial losses. The focus on transitioning to EVs must be accompanied by efforts to enhance consumer awareness, improve charging infrastructure, and address concerns about range and reliability to drive broader market acceptance. Number 7. Competitive landscape. The competitive landscape for electric vehicles is becoming increasingly crowded, with established automakers and new entrants vying for market share. While traditional automakers have the advantage of brand recognition and established distribution networks, newer companies like Tesla, Rivian, and Lucid Motors are challenging the status quo with innovative designs and technology. As competition intensifies, automakers may need to invest more resources in marketing and R&D to differentiate their EV offerings. This can lead to escalating costs and a prolonged path to profitability, particularly if they are unable to capture a significant share of the growing EV market. Number 6. Regulatory challenges and compliance costs. The transition to electric vehicles is heavily influenced by regulatory frameworks at both the federal and state levels. Automakers must navigate a complex landscape of emission standards, tax incentives, and environmental regulations that can vary significantly by region. While regulations aimed at promoting EV adoption are generally favorable, they can also introduce compliance costs and administrative burdens for manufacturers. Furthermore, changes in government policies, such as potential rollbacks of EV incentives or shifts in emissions regulations, can create uncertainty for automakers. This regulatory unpredictability may deter companies from committing to long-term investments in EV factories if they are unsure of the future landscape. Number 5. Technological advancements in battery costs. Technological advancements are critical to the success of the electric vehicle market, particularly regarding battery technology. The cost and performance of batteries significantly impact the overall price of EVs and their appeal to consumers. While there have been substantial improvements in battery technology, such as increased energy density and reduced costs, these advancements have not been uniform across the industry. Many automakers still face high costs associated with sourcing batteries, which are a major component of EV manufacturing. The reliance on lithium-ion batteries means that fluctuations in raw material prices, particularly lithium, cobalt, and nickel, can lead to increased production costs. As automakers invest in new factories, the challenge of securing affordable and sustainable battery supplies can hinder their ability to deliver competitively priced electric vehicles. Number 4. Infrastructural limitations and charging networks. The availability of charging infrastructure is a crucial factor in the widespread adoption of electric vehicles. While investments are being made in expanding charging networks, many areas, particularly rural or underserved regions, still lack sufficient access to charging stations. This infrastructural limitation can create significant barriers for potential EV buyers who may worry about their ability to charge their vehicles conveniently. Automakers are beginning to recognize the importance of collaborating with charging network providers and government agencies to address these infrastructure gaps. However, establishing a comprehensive charging network requires substantial investment and long-term commitment. Number 3. Consumer education and perception. Another challenge hindering the profitability of EV factory investments is the need for consumer education regarding electric vehicles. Many potential buyers still harbor misconceptions about EVs, including concerns about their performance, reliability, and total cost of ownership. The perception that EVs are inferior to traditional gasoline-powered vehicles can deter consumers from making the switch. To overcome these barriers, automakers need to invest in robust marketing and educational campaigns that inform consumers about the benefits of electric vehicles. By highlighting advancements in technology, charging options, and potential savings on fuel and maintenance, automakers can help shift public perception and increased interest in EVs. Number 2. Financial health of automakers. The financial health of individual automakers plays a significant role in their ability to invest in EV factories successfully. Many companies face substantial debt loads and ongoing operational costs associated with maintaining traditional vehicle production lines. These financial pressures can limit the resources available for investing in electric vehicle manufacturing, leaving companies struggling to balance their existing commitments with the need to transition to new technologies. Automakers with weaker financial positions may be less willing to take risks associated with EV investments, particularly if they are uncertain about future demand. This reluctance can lead to slower transitions toward electric mobility and missed opportunities in a rapidly evolving market. Number 1. Global competition and market dynamics. The global automotive landscape is becoming increasingly competitive, particularly as new players enter the electric vehicle market. Companies like Tesla have set high standards for innovation and performance, compelling traditional automakers to adapt quickly. In addition, emerging markets such as China and India are rapidly developing their EV sectors, creating additional pressure on U.S. automakers to remain competitive. This global competition can make it difficult for American manufacturers to differentiate themselves and establish a strong market presence. The need for continuous innovation and responsiveness to consumer preferences adds to the financial strain on automakers, especially those with substantial investments in EV factories. As competition intensifies, the challenge will be for automakers to leverage their existing strengths while embracing new technologies and partnerships that will allow them to thrive in the global EV market. Thanks for joining us on this insightful exploration of the hurdles facing EV factory investments in the U.S. If you found this analysis as thought-provoking as we did, don't forget to like, share, and subscribe for more in-depth discussions on the future of the auto industry. Drop your thoughts in the comments. What do you think could help turn things around for automakers? Until next time, stay informed and stay engaged.